Let us see the topic finance risk and return. Introduction. Return and risk is an important factor in financial decision making. Investors are generally risk averse. They demand compensation for bearing risk. We discount the future cash flows for time, value of money, and degree of risk to choose among investment decisions. Meaning, the term return refers to income from a security after a defined period, either in the form of interest, dividend on market appreciation in security value. On the other hand, risk refers to uncertainty over the future to get its return. In simple words, it is a probability of getting return on security. Return in finance. Return is a measure of an investment. Total interest, dividends, and capital gains expressed as a financial gains or loss over a specific time frame. Risk in finance. In finance, risk refers to the degree of uncertainty on or potential financial loss. Interest in an investment decision. Generally, as investment risk rise, investors seek higher return to compensate themselves for taking such risk. Every saving and investment product has different risk and returns. Example of risk and return. By the same token, the smaller the risk an investment poses, the smaller the potential return it will be provided. For example, a startup business could become bankrupt or it could become a multi-million dollar company. If you invest in the stock of this company, you could lose everything or make a fortune. Risk have two types, that is systematic risk and unsystematic risk. Systematic risk that affects the entire market, not just a particular stock or industry. And the systematic risk, also known as validity risk or market risk, affects the overall market, not just a particular stock or industry. Unsystematic risk, the uncertainty inherent in a company or industry investment. Unsystematic risk refers to risks that are not shared with a wider market or industry. Unsystematic risks are other specific to an individual company due to their management, financial obligation, or location. Return have three types, that is have mutual funds, bonds, stocks. Mutual funds. A mutual fund is a pool of money managed by a professional fund manager. It's a trust that collects money from a number of investors who share a common investment objective and invest the same in the equities. Bonds. A fixed income instrument that represent a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as an IOC between the lender and borrower that includes the detail of the loan and its payments. Stocks. Stocks are a type of security that gives stockholders a share of ownership in a company. Stocks also are called equities, US securities, and exchange commissions. Conclusion. Risk and return analysis help firms make smart investment decisions that consider both potential profit and risk. It provides a framework to evaluate investments.